Welcome to Options in Plain English Advanced Edition. Today we're going to talk about calendar spreads and in general, calendarized option strategies. Calendarized option strategies take advantage of the faster time decay rate in the front expiration when compared to the back expiration. This is why typical calendar spreads are short the front and long the back expiration. In terms of direction, calendars and diagonals benefit from the underlying price expiring at the front expiration's short strike price. An additional advantage that traders see in calendarized strategies is the fact that since the position is long the back expiration with a higher Vega, these positions appear to be Vega positive. Nominally, when looking at their trading platforms after initiating a calendarized position, they would see a positive Vega number, and then they would have a position that is both long theta and also long Vega. The problem with this approach is that those Vegas, front and back expiration, are not measuring the same thing. The IV in the front and back expirations, although related, are not exactly the same because of the term structure of implied volatility. We explored this discrepancy in this lesson and see how Vega numbers for calendarized strategies on their own might be misleading. This is not an indictment on calendarized strategies in general, since we do believe that they have a place in an option trader's portfolio. It is rather an attempt at understanding how they work and why some of the numbers that traders might see both on their individual positions and in their portfolios in general might need to be analyzed further when dealing with positions or portfolios that span multiple expirations for options on the same underlying. We're going to start by talking about which positions have calendarized components that are going to be affected by what we're going to be talking about today. So, as the title suggests, we're talking about calendar spreads, and in this case, we could be talking about a calendar spread with puts, a calendar spread with calls, but also we could be talking about diagonals, and we have diagonals that are diagonal long put spread, diagonal short call spread, diagonal long call spread, and a diagonal short put spread. The one thing that all these positions have in common is that they have components, they have options, both on the front expiration and on the back expiration. So they have options that are calendarized. So they have options in different expirations. So in this case, for example, with a calendar spread with puts, you are short a put in the front month, and then you are long a put in the back month. And I'm going to be referring to month instead of expiration sometimes. But just understand that it could be a weekly expiration as well. It doesn't have to be the monthly expiration. In the case of calendar spread with calls, we're talking about being short a call in the front month and then being long a call in the back month. So if you're at the money here, for example, then what you're trying to do is you're trying to take advantage of the higher theta in the front where you're short the option, in this case the call, and this is going to have a higher theta and you're going to be benefiting from it because the back month is not going to have such big theta. So in this case, you're trying to pin the strike at the same time as you want time to pass. Okay, so this is why they have a certain range where this position is profitable. And by the way, when you have a calendar spread, you have two different expirations. And what you want to do is you are going to analyze this position as if you're taking the whole thing off when the first one drops off, when the first one disappears, when the first one expires. So this is an analysis that you're doing not until the back expires, but only until the front expires. In the case of diagonals, we're talking about something similar, but the difference is that both front and back don't have the same strike price. So in this case, for example, when we're talking about a diagonalized long position or a diagonalized long spread, such as a call spread or a put spread, the back month is the one that is deeper in the money. And when you're talking about a diagonal short spread, the back month is the one that is out of the money or less in the money compared to the front month. So in this case, for example, a diagonal long call spread is sometimes referred to as a poor man's cover call, because this call in the back month is going to be deep in the money, and it's going to have a high delta because it's in the money, and it's going to function more or less as a substitute for long stock. And since you are short a call with long stock, this is a kind of a cover call. So in any case, the most important thing here is that what we're going to be talking about affects not only calendar spreads, but also anything that's calendarized. So it could be diagonals, it could be calendar spreads with calls, with puts, etc. So all of these positions are going to be affected by what we're going to be talking about. Now we're going to analyze one of the calendarized option strategies, and we're going to be talking about a calendar spread with puts, in the understanding that this applies to all the different types of calendarized option strategies, or any position where you have options on two different expirations. Okay, so very simply, I'm not going to talk about how the calendar spread works, but I'm just going to say that the structure here is short one at the money or out of the money put in the front month, and long one in the back. So same strike price, short the put in the front month, long the put in the back month. If the price is here, if the underlying price is here, you are shooting for the price pinning your strikes at the expiration of the first option, so at the front month's expiration. Okay, so this analysis, this distribution of profitable and losing areas is based on the position being taken off at the front month's expiration. Okay, so short the front, long the back, same strike price with puts. Okay, now something that's interesting to notice here is that for this position and for all of these positions, the break-evens are going to be undefined because they depend on the implied volatility. We're talking about two different expirations, so they have two different volatilities: time to expiration and also volatility skew. So pay attention to this, because this is going to come into play later on. Also, the max profit is not directly or accurately predicted here, because it also depends on implied volatility, time to expiration, and volatility skew. In this case, you can get an approximation, but you're not going to be able to get an accurate number the same way you could when you're talking about the same expiration. So anything vertical. So if we start analyzing the calendar spread with puts, you're going to have all the different properties of the strategy, and we're going to look at the front expiration and the back expiration. So we're going to analyze the components. Okay, so we're going to start by saying that the options, in this case the puts, in the front expiration you sell them, and the back expiration you buy them. Okay, so short the front, long the back. We already knew that. And we're going to start analyzing now the Greeks of those components. If you think about the delta, and you remember the analysis we did for the different Greeks, when you analyze delta versus time to expiration, remember the green is when you have a lot, the black is when you have less, and the red is when you have the least. We're talking about here an option that's out of the money. So an option that's out of the money would be equivalent to analyzing this side of the chart or the graph. So when you have a lot of time, you have a higher delta. When you have less time, you have a smaller delta, because it's about to become zero if it expires out of the money. So the delta in the back is more than the delta in the front, and that's what I have here. The front expiration is going to have, and remember, we're talking about absolute values here. We're not talking about signs, okay? So front expiration is going to have less delta. Back expiration is going to have more delta. Now, theta versus time to expiration. When you have, remember, we're trying to pin the strike. So we're going to analyze something that's very close to the at the money, okay? So when you have a lot of time here, this would be the green line, you have very little theta. But when you have very little time, you have a lot of theta. Because of this, when you have the front expiration is going to have more theta than the back expiration. And this is one of the things we're banking on. We are expecting to have higher theta in the front than in the back because you are short an option, which means you're going to be benefiting from this decay, from time decay, okay? So more theta in the front, less theta in the back. Now, remember, gamma moves in tandem with theta, so it's going to have the same interpretation here for front and back expirations. We're still going to look at it. Gamma versus time to expiration, same thing. In the back, you're going to have very little gamma. In the front, you're going to have a lot of gamma, okay? Because it moves together with theta. Now, Vega, which is going to be the one we're going to be focusing on, we have the Vega versus time to expiration here. In the front month, with very little time to expiration, you have very little Vega. And in the back, when you have a long time to expiration, you're going to have more Vega. So you have less Vega in the front month, more Vega in the back month, okay? So if we start analyzing and we try to think of how this affects this position in particular, the calendar spread with puts, you can see that the delta is going to be short, which makes sense even visually here because the price is here, you want it to pin here. So you want the price to go there, you want the price to go down. So you're short delta. You are long theta because the front month is going to start decaying at a faster rate than the back month. You're short gamma because in this case, your gamma in the front is going to be more than the gamma in the back, okay? And because gamma has the opposite sign to theta, then you are going to be short gamma. So you're going to have a risk right now because being short gamma, you are hoping that it doesn't move a lot. Any violent move, any big price move is going to affect you negatively. And this makes sense. If you're here and it moves violently to the upside, you're going to lose money. And if it moves violently to the downside, you're going to lose money as well. So you're short gamma. And Vega, you are long. You have less Vega in the front, more Vega in the back, and your back expiration has positive Vega and your front expiration has negative Vega because you're selling the option. So you have very little negative Vega, you have a lot of positive Vega, so you're long Vega. So this position, the calendar spread, if you look at it nominally, if you look at your platform, you're going to your platform is going to tell you that you have a position that is long theta and long Vega. So if time passes and nothing happens, you're going to benefit. But also, if the market perceives the environment to be conducive to big moves, it's going to increase the implied volatility. And you're going to be long implied volatility, so you're going to benefit from it. So you are basically having your cake and eating it too, because you're banking on nothing happening, just time passing, and you're also banking on things happening, okay? So it appears that this position is going to be a winner no matter what. So where is the discrepancy? We're going to take a look at where the discrepancies are. In order to do this analysis, we have to think about what we just saw. We saw that the calendar spread with puts, what it has is long Vega in the back and short Vega in the front. Now, the Vega in the back is measuring the implied volatility in the back, and the short Vega in the front is measuring the implied volatility in the front. So those two volatilities are not the same, okay? And this is visually depicted when you look at any type of graph or any chart, or you look at the numbers for the different volatilities, analyzing the term structure of implied volatility. You're going to see that you have, for example, if you have a calendar that's short the 30 days and that is long the 90 days, then you're going to have different implied volatilities affecting both legs. And those Vegas in the back and in the front are Vegas that are going to be driven by the back implied volatility for the back Vega and the front implied volatility for the front Vega. So you have to be aware of the fact that they are not being driven by the same thing. So you can't just add them up. The sum of them is going to be driven by what? The front or the back? They're two different things. To look at real data and a real example of how this is this happens in the marketplace, what we're going to do is we're going to look at some historical implied volatility term structure graphs. And what we're going to do is we're going to look at the SPX, so the S&P 500 index, because it's very easy to get historical information for the VIX. So the VIX measures the implied volatility for SPX, and the VIX has a very defined term structure. There's VIX for 30 days, 60, 90, etc. So what we're going to do is we're going to look at SPX, and this is what SPX looks like, okay? So this is what it's looking like right now, okay? And what we're going to do is we're going to see, so the premise behind a calendar spread, or the Vega component of a calendar spread, is that, okay, when the market starts crashing, I'm going to get an increase in volatility, and that's going to benefit my back month, and I'm going to be making money because I have a higher Vega, because I'm long the back, short the front, and the back itself has more Vega. Well, we're going to see whether that would have been the case, and we're going to analyze the VIX information for the SPX, which is the S&P 500 index, and we're going to analyze the information for these days, okay? So we're going to start and looking at what the term structure looked like on this day, which was February 19th, then 20, 21, 24, 25, 26, 27, 28th. We're going to analyze this period, and we're going to see how the implied volatility for SPX, which is the VIX, moved, not only how it moved, but how the different expirations for implied volatility moved. So we're going to look at the term structure of implied volatility over a series of different days and how it reacted to this market crash, pretty much. Okay, so because this is when you want to have your calendars, right? When implied volatility goes through the roof, you're going to want to have your Vegas ready to give you the profits that you want, right? And also, after that, we're going to see where this ended up. We're going to cheat and go to the lowest point, and we're going to get the information, the term structure for this day as well, which is March 24th. And we're going to look at VIX, and we're going to see how it behaved and what would have happened if we had a calendar spread, whether that would have been beneficial to us. And in theory, it would have, because now you have an explosion in implied volatility that we're assuming that's going to happen, because look at how the market collapsed. And this is exactly the situation where those calendars are going to come handy, right? When you have a market crash, the implied volatility is going to explode. It's going to go really high, and you're going to benefit from it. So we're going to see now how those volatilities moved in different durations, in different expirations. Okay, so let's take a look at the first day. This is February 19th. So this is right here. Things are calm. You don't know what's going to happen. This is a typical term structure of volatility. This is a typical IV term structure. Okay, so and by the way, thanks to our friends at VIX Central, we took the information from there, and they're an excellent website. Highly recommend it. So this is February 19th right here. This is what the implied volatility looks like, okay? For 30 days, you have around 15. And I'm not going to go with the actual exact numbers, okay? I'm just gonna, I want you to look at this visually and see how the market reacts to a collapse in the market, in a certain, in this case, in an index, but it could be an individual name as well, individual company, okay? So we have this, which is a very normal, typical structure of volatility. This is called contango. So the back volatility is a little bit higher, and the front volatility is a little bit lower, okay? So this is a very typical structure of volatility. This is really, really far in the future, so there might be something else happening here. But we don't care about 270 days. We care about the something that's closer to like 6 months. So this portion of the term structure. So on the 19th, we have this. Then on the 20th is the first negative day, okay? So yeah, it perks up a little bit. It goes up here, it goes up here, and here, and here. So the whole thing shifts pretty much in parallel because you don't know what's going to happen. This is just a regular negative day. It's going to push the implied volatility a little bit higher. But again, the basic shape is still the same, okay? Now, second day of the decline, this is going to be a Friday. This is going to be February 21st. So February 21st, now you have this one starting to have a bit of a different shape, okay? So now you see the front month being affected a lot. The back months are also starting to get affected. But still, overall, you still keep the same shape. So now we're going to see on the Monday, which is going to be February 24th, you're going to see what happens with the volatility. Okay, so this is February 24th. So now you're seeing things that are really different. Now, the shock that is the decline in the market is going to hit the front month much more than the back months, okay? So this is around, this is 30 days. So this is around, I don't know, 20 days or so, 50 days. This is around 80 days and so on. So one of the first things that you can notice here, so from the 19th to the 24th, this is only 4 trading days, okay? The front month went from 1537 to 20. So this is a big increase, because we're talking about $5, around $5, on an index that's trading at 15. So it's about 30%. The next one went from 16 to 19. Still a big move, but not nearly as big. I would say it's around 26-27%. The third one went from 1652 to 1842. So it's only about $2 or 2 percentage points that it went higher by. So as you can see, the front moved a lot. The next one moved comparatively less than that, but still a lot. The next one moved less and less and less, partially because they're starting from a higher level, and also because they just didn't get that high. So for example, here, 210 days went from 1737 to 1845, not even one single point, okay? And we already went through these 4 days. So you can see that in the back, the effect is minimal. It's almost imperceptible. It's almost, you can't even tell that it happened, okay? Now we'll continue on the February 25th, on the next day. Now we're up to 22, 2019, and then 26. Now it's still 22. But look, this went from 1537 to 22. The next one went from 1632 to 20, almost 21. And the third went from 1652 to 1972. So around $7, around, it went higher by around $4, and it went higher by around $3.50. Okay, so look here, $7, and from a lower base, from a lower level. Okay, so $7 out of 15, it's almost 50%. Okay, and this one, the 16 went to 19, so it's about $3, $3.50. We're talking about what, 22%? So we're talking about 50% versus 20%. Okay, so you can see that the back is moving much less than the front. Okay, we're going to continue here. This is February 27th, this day. Now we're up to 26, 23, 21. Now the shape of the curve, look how different it is. It used to be that the front was low and the back was high. Now the front is high and the back is low. This is called backwardation. When you're talking about term structure, if the front months are higher than the back, it's a reflection of the market being bidding up the values in the front and staying at pretty much the same level on the back. That's called backwardation, as opposed to a shape such as this one, which is called contango. Okay, so this is February 27th, and February 28th is going to be the last that we're going to analyze from this period. And what you can see is now we're at 26, 23, 21. It used to be 15, 16, 16. Okay, so this one went higher by $5. This one went higher by 16 to 23, $7, and this one went higher by $11, 15 to 26. Okay, so the front month reacted much more to this event than the back. Okay, so that's what I wanted you to see, that those Vegas in the back are going to be driven by a different volatility. Here we're analyzing it for VIX and SPX, but it works the same way for the individual volatilities pertaining to each and every one of those underlyings, whether they're companies, ETFs, futures. It doesn't matter what they are, indices, it doesn't matter what they are. They are all driven by back month volatility, which reacts less when it comes to a shock to the system. Finally, I'm going to cheat and I'm going to go to March 24th, which was the lowest point here that we had, and look at finally when we analyze what happened. Look, the front month went from 15 to 48. Okay, I'm not even going to try to get the percentage, but this is about, I don't know, something like over 200%. The back month, the second one, went from 16 to 40. So the front month went 15 to 48. We're talking about 33 percentage points. Okay, 33. And the back is going from 16 to 40, so 24 percentage points, 33, 24. Okay, the third one went from 16 to 35, so we got 33, 24, and 19. So you can see how the front month is affected much more than the back month. So it doesn't matter that you had huge Vegas here. They're going to be driven by a number that's not going to move a lot compared to the front month. Now, the front month, remember, you had negative Vega, and you're going to have to absorb those losses based on this. Okay, so your front month is going to be affected much more, and that's the one that you're short. Okay, and in this case, when you are talking about being long a calendarized strategy, you're always long the back and short the front. So you are exposed to a situation like this. So in this case, it's not only the fact that implied volatility went higher, but rather the fact that the term structure went from being in a contango structure to a backwardation. And that's what's going to hurt your position. So even though your calendar, if you look at it in your platform, it looks really nice. And when you see that the implied volatility went higher, you think to yourself, I'm going to make a lot of money here because I'm long Vega. Yes, you're Vega in the back month, but you're not long Vega in the front month. You're actually short Vega. So you can't just add up the Vegas that you have because they're being driven by different things, by different volatilities. Okay, and this is what I wanted you to see visually, and this is how the VIX reacted to the SPX, but it's going to be something similar for every underlying. So now we saw what happened, and we know now instinctively that those Vegas are going to be misleading, okay? The Vega versus time to expiration, the back month is going to have a higher Vega, and the front month is going to have a lower Vega, but this Vega is being pushed by the front IV, and this Vega is going to be pushed by or pulled by the back IV, okay? So those are measuring two different things, and you should not add them up. So what these, if you look at those numbers and you call them raw Vega, so the numbers that you get from applying the formulas, those raw Vegas are misleading. That's the crux of this whole lesson. That's the main thing that you need to take away from this lesson, is that the Vegas in the front are not the same as the Vegas in the back. So we have this Vega being driven by back implied volatility, and the front Vega being driven by front implied volatility. And since those two are not the same, this is not directly comparable, and this is not directly something that you should be adding up to get your total exposure. Okay? So the conclusion is that the raw Vega needs to be adjusted or normalized when dealing with different expirations implied volatilities. We saw that those implied volatilities move independently, and because of this, you cannot just take your Vegas and add them all up. Okay, so whether you have a single position such as a calendar or a diagonal, or you have several different positions in your portfolio that are independent but that have different expirations for the same underlying, you're going to have to adjust them somehow because those numbers are going to be misleading. There is no straightforward way of normalizing IVs with different expirations, since they depend on term structure. And we saw the term structure could go from contango to backwardation. It could get flatter, it could get steeper, it could stay the same and just shift up in shift the values, but in a parallel manner. So you don't know what's going to happen. It's just the dynamics of implied volatility, which in itself is a subject that a lot of traders and scholars have been trying to determine how it works, and it's very difficult to try to predict how the term structure is going to react to different events. Say, for example, nothing happens, then what's going to happen to the term structure? Is it going to just sink with the same shape, but just everything with a lower value? But that's what usually happens. Or would it go a little bit steeper or a little bit flatter? You don't know what's going to happen. So it depends on that. Some traders normalize those implied volatilities, or the Vegas, by applying a square root of time factor to get an approximation. So in this case, since you know that the front month is going to move much more than the back month, then what you can do is you can adjust your back month numbers and have a lower Vega influencing the whole position and measure everything related to the front. Or you can do the opposite. You can take the Vega in the front and look at the implied volatility in the back and know that this is going to move by more. So then you would increase the number in the Vega number in the front and work based on the implied volatility in the back. How you do it is a subject for another lesson, for a very advanced lesson. But what's important for me is that you understand that those Vegas are measuring different things. And because of that, those numbers are not directly applicable when you look at your positions. This is going to be key for you to understand how anything calendarized works. You can still bank on pinning a certain range or a certain strike and waiting for theta to do its magic and start eroding the front month much more than the back month. You can still do that. They're going to work for that. But the calendars are not going to work if you expect the position to be a good one when implied volatility goes higher, because implied volatility does not go higher in the same proportion for all the different expirations of implied volatility, which is the term structure. Also, calendars are especially beneficial if you think about having a back option, for example, a back put that you're long, and you sell not only one time but many times. The let's say you have this one, the long is 6 months, okay? Rather than having a 3-month short option here, if you can, instead of doing 1 3-month option, if you can do 3 1-month options or 12 weekly options, then because theta accelerates prior to expiration and at expiration, then you're going to be in a better position to make more money, to have more profits doing that. For that, calendars work perfectly. What they don't work for is if you're banking on implied volatility making you money when you have a calendar. So I hope this was a little bit clear. I know it's a difficult topic, and I've been asked this question many times before. That's why I wanted to address it in a single place. And I hope this is clear now. And even though there is no known solution for this, at least you're aware of this, and you know what position you have when you put this on. Thank you very much for your attention, and goodbye.